G20 finance ministers have endorsed a plan to roll out a global minimum corporate income tax rate of 15% within the next 2 years. More than 130 countries have already signed onto the agreement, which is aimed at making large multinational corporations pay more, Mobin Nasir reports.
They're everywhere. Millions of people use the services of big tech companies every day. From watching movies to socializing with friends online, it all helps them earn billions of dollars. Yet the likes of Google and Facebook pay very little or no taxes. Now, world leaders are pushing for that to change.
It is a tax revolution. It is a tax revolution because for the first time, the digital giants will have to pay their fair share of taxes in Europe and everywhere in the world.
Finance ministers from the world's 20 biggest economies ratified a plan to impose a global minimum corporate income tax rate of 15%. These levies will have to be paid where the money was earned rather than where these multinational companies' head offices are.
This is an important result that provides an effective response to the tax challenges arising from the digitalization and the globalization of our economies.
More than 130 countries have already agreed to implement these reforms by 2023. That could stack up tax liabilities much higher than before for many of the world's biggest brands. Between 2010 and 2019, the collective revenue for Facebook, Apple, Amazon, Netflix, Google parent Alphabet, and Microsoft was $4.6 trillion in the US. Their combined profit was $1.1 trillion. They paid $180 billion in corporate income tax on these earnings. That's just 16% of their profits, much lower than the annual average federal corporate income tax rate of 35% during the period. And it's deprived the US Treasury of more than $155 billion. Multinationals pay even less in other countries by setting up offices in tax havens like Panama and Ireland, which charge little or no corporate income tax. But some of these countries are also signing up to raise rates.
It is a sensible and a pragmatic decision made by the government in the interests of our country, and ultimately a decision that I believe will be critical to conditions to create longer-term certainty for businesses and investors, which in turn will be to the benefit of many thousands of employees.
G20 leaders are expected to approve the plan at a summit in Rome at the end of the month. Some economists say a uniform tax code will benefit most countries and foster healthy competition among companies.
A global minimum tax at a higher rate would be a very powerful instrument to curb corporate tax avoidance, profit shifting to tax havens, and to end global tax competition, the race to the bottom with corporate income taxation.
But critics say the agreed tax rate is too low and will limit revenues for emerging economies. Whatever the outcome for government revenues, it's clear big tech is in for taxing times. Mobin Nasir, TRT World.
Earlier, Director of Applied Economics at George Washington University, Joann Weiner, joined the show. She says the agreement over a global minimum tax for corporations is a historic step, but that a central authority would be needed to implement it.
Well, that's a very good question to ask about who will police the effort. Way back when I worked at the U.S. Treasury Department, when the OECD countries were also considering how to curb harmful tax competition, there was a discussion of something called a World Tax Organization, the WTO for tax. And that clearly is an ambitious goal to try to get companies to agree to the rules that the countries set. That said, it is quite remarkable that more than 130 countries did agree to a global minimum tax rate of about 15%. That's astounding in my view. Ireland, its tax rate is now 12.5%, so they're going to agree to go up to 15. Hungary is going up from 10 to 15. Now there are phase-in rules and what have you, but to get countries to agree to raise their rates in the interest of global tax harmony is, as I said, astounding. I don't think the rate is too low. The countries need revenue for various reasons, and they raise it from various different sources. Corporations it's pretty easy for them to locate their profits in low tax areas. And so going much higher than 15% is just going to encourage more tax evasion or tax avoidance. And so in my view, I don't think it makes sense to go higher than 15%. And in fact, Ireland was able to come onto the agreement by eliminating those two words of at least 15%, actually keep it at 15%.